Welcome to the Wall Street Exclusive Daily Show. I'm Joe Springer, helping you make informed decisions so you can succeed in the market. I have three great pieces of information for you today. The first is I will give you three keys to stock picking. Three keys to stock picking. I've already given you three. We'll review those three and give you three more. Number two, we'll show you how to value a stock. What are stocks worth anyway? How do you figure that out? There actually is a way to figure that out. We'll show you. Number three, we'll play Know Your SEC Forms. We'll show you what are perhaps the four most important SEC forms to know about and always be checking on. But first, does Jim Cramer want you to fail in the market? Now, I didn't want to have to do this, but just listen to this and maybe you'll agree that we had to respond to this. Now, this is what Jim Cramer said last night. Quote, "Hey, I'm Cramer, welcome to Mad Money." End quote. That's what he said. But now listen to this. This is what we imagine he meant by that. It's not what he said, but it is what we imagine he meant by that. Quote, "I, Jim Cramer, hope the fans of the Wall Street Exclusive fail in the market. I'm Jim Cramer." End quote. Oh, Cramer! Well, you know, I don't care if Cramer or someone else wants you to fail. We're here to make you succeed, help you succeed in the market. I don't care if Jim Cramer wants you to fail. So listen, you come to the Wall Street Exclusive, you're in the right place. We're going to help you succeed in the market, whatever Cramer wants. Okay, so we're going to give you three keys to look for when you're picking stocks. So we said already that listen to Warren Buffett, and Warren Buffett needs to buy the big, huge stocks like Exxon and Bank of America. So don't look at those. Look at stocks under $10 billion. Okay, so we said look at small stocks. We also said be on the side of the insiders. If insiders are buying, that's great. If they're holding, okie dokie. If they're selling, that's not okay. So you want to be smaller stocks where the insiders are on your side. Okay, that's good. And the third thing we said was competitive advantages. Remember we showed 6 sustainable competitive advantages. So there's 3 things you're looking for when you're picking stocks. Here are 3 more. Number 1, always looking for asymmetric upside. You got to have a lot of upside, the sizzle. You're looking for doubles and triples and 10-baggers and nothing else. And it really is okay to do that because no stock is safe. Literally every single stock has downside, but not every stock has a lot of upside. IBM, you know, there's the expression, nobody ever got fired for buying IBM, no portfolio manager ever got fired for buying IBM. Well, if you would have bought IBM at the end of last year, you would have lost a quick more than 20%. The oil and gas companies were considered some of the most reliable. Many of them got poleaxed. The entire energy complex sold off in the last 6 months. If you were in the wrong name, even if they had been doing well for years, paying dividends, no stock is safe, so you must have a lot of upside. You're looking for doubles, triples, and 10-baggers. Now, I like the idea of this, but I didn't know that people actually do this very well, professionally, successfully. Monish Pabrai, I've talked about him before, very, very, very wildly successful hedge fund manager. That's all he does. If it can't double, he doesn't want it. It's got to be a double, a triple, or a 10-bagger. And so that's what you should do. And in the daily double portfolio, that's not a gimmick that I have a daily double portfolio. That's what we're doing. Every stock has downsides, so I'm only looking for stocks that are multi-baggers, and that's it. And in the daily double portfolio, we are beating the S&P 500, of course. And in my opinion, we're going to continue to beat the S&P 500, and we're not flitting in and out of stocks, doing a lot of trading. We're not doing much trading at all. We're just picking really good companies that we think are good buys, companies that can double, triple, or better. Okay. So number 1, you got to have upside. Every stock has downside. Make sure your stocks have a lot of upside. Number 2 is the balance sheet. You want to look at the cash and debt situation. Okay, and so basically there's speculative companies that are not profitable yet and then profitable companies. With the speculative companies, mostly they're not going to have debt. If they don't have earnings yet, they probably got the money that they are using now to operate when they did their IPO. So when they sold shares initially in their initial public offering or subsequently in a secondary offering, that's where they got their cash probably, so they probably don't have debt. Speculative companies generally don't have debt. But what you're looking for in those speculative companies is what is their cash burn rate? Do they have $10 million in cash on the balance sheet and they're burning $1 million a quarter? They're probably good for a while. Okay, that's good. But if they're about to run out of money, they're going to have to do a secondary, and that's what you're looking for. Okay, so generally it's a bad idea to buy right before a company does a secondary. It's not always true, but generally speaking, it's a bad idea to buy a company that's about to do a secondary. And also, generally speaking, if it's a good company, right after they do the secondary is a brilliant time, generally speaking, to buy a company. A lot of good companies will sell below what maybe they should because they can, you know, they're about to issue shares, and right after that, perhaps it'll run up a little bit. So We're looking for the balance sheet, and so in speculative companies, you want to make sure they're not about to issue shares. In the other type of company, a non-speculative, perhaps a profitable company, they might have debt, and that's good that a lot of companies have debt. For example, if a company can borrow money to expand their business and they get a 10% return on that money, then it makes sense to borrow money at less than 10% a year. So good companies generally do have debt. It makes sense. Okay, but what you want to do, if your company does have debt, you want to make sure you check the bond market. So what they do is they sell bonds, and you want to see how those bonds are doing. If people are selling those bonds because they don't want them anymore because they don't think this company is going to be going to stay as a going concern, then the yields on those bonds might go up to like 20%. I wrote an article over the summer about the coal stocks called It's the End of the Coal as We Know It. Peabody, Arch Coal, Alpha Natural, all of those are down by half or 2/3 since I wrote about it. And the whole point of the article was if you're looking at the bonds of those companies, they're being sold off and they're yielding like 20% now because people don't think they're going to be able to pay their bills. People think they're going to go bankrupt. They may or may not. But remember that the stock comes after the bonds if a company goes bankrupt. If a company goes bankrupt, almost every single time, stockholders lose everything. Okay, so that's number 2. You have to know what's going on with the balance sheet, okay? So we said small stocks where the insiders are on your side, have a competitive advantage, that have a lot of upside, and then also now we're looking at the balance sheet. If they're speculative, want to make sure they're not going to issue shares. If they're not speculative, want to make sure their debt is still in good shape, that it's not being sold off because the company might go bankrupt. Okay, and then number 3, or number 6, depending how you look at it, is management. Management is sort of famously hard to assess. It's qualitative, not quantitative. So how do you tell if a company has good management? Walter Schloss, very famous value investor, said he stopped listening to management because they always convinced him that their stock was good. And so he said, they always convinced me. I just stopped listening to them. So I understand that. So how do you assess management? Well, 3 things to look for with management. 3 things. One is their record. That is hard data you can look at. Was it ever involved in a fraud, a pump and dump, any indiscretions, anything like that? There's a lot of companies that have management that was never involved in any of that stuff, so you can move on when you see that stuff. Look at the management's records. If they are involved in any shenanigans, move on. Number 2 is look at management's incentives. Here is, again, concrete information you can look at. For example, Hormel Foods is the only stock above $10 billion that's in the daily double. It's already up 15% for us, 13% since we added it last month. And the reason we added that big stock is it had everything to do with management's incentives. About 80% of Hormel's executive compensation is based on performance, plus every director and officer is required to own stock at a multiple of their salary. So management's interests are aligned with shareholders, and that's what you're looking for when you're assessing management. Just like we were saying, we want management buying or holding, not selling their stock. You want the management's interest to be aligned with shareholders. Okay, the third thing you're looking for with management is specificity. Management not just to be good in general, but specific to what they're doing. Like Tonix has a CEO who is a rheumatologist treating fibromyalgia. So he's not just a doctor in general, and that's good for a biotech to have a doctor CEO. He specifically knows exactly about the markets that they're doing. So look for specificity. That's another thing you can look for. Okay, so when we're evaluating a stock, you want to make sure you look for asymmetric upside. Every stock has downside. You've got to have upside. Okay, we said you want to look at the balance sheet. For speculative companies, you want to make sure that they're not about to issue shares. For companies that have debt, you just want to keep an eye on the debt. If that debt starts selling off, get out. And number 3 was management. And we said the 3 things with management was their history. Have they ever done anything shady? Number 2 was their incentives. Are their interests aligned with yours, the shareholder? And number 3 was specificity. Are they not just good in general, but specific to their markets? Okay, does Jim Cramer want you to fail in the market? Well, that will never matter here at the Wall Street Exclusive. We're here to help you succeed. We're here to help you make informed decisions so you can succeed in the market. Coming up next, we will look at how to value a stock. Can you value a stock? Is it all just random? Nope, there's a way to value it. Stocks actually do get valued on something, and we will show you how to value a stock.